If Benjamin Graham's book, The Intelligent Investor, was the Lord of the Rings, it would be the one ring to rule them all. It is the book that connects all the great investors such as Warren Buffett and Charlie Munger. In this video, we will explain the top 20 quotes from the book, The Intelligent Investor. Quote number 1. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. To invest successfully, you don't need a high IQ or unusual business insights. What you do need is a good strategy that allows you to make intelligent decisions and keep your emotions in check. Quote number 2. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. Have a lot of discipline and courage and don't let other people's mood swings influence your investing. Quote number 3. Investing isn't about beating others at their game, it's about controlling yourself at your own game. Always stick to your investment plan and goals, and playing your own game. One of the great things about investing is that there are many ways to play the game of investing, and always stick to your own strategy. Quote number 4. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioural discipline that are likely to get you where you want to go. Abnormally good or abnormally bad conditions do not last forever. In the long term, the stock market will be the best place to invest your money in. Quote number 5. The sillier the market's behaviour, the greater the opportunity for the business-like investor. Mr. Market is there to serve you. Use volatility to your advantage. When Mr. Market is pessimistic, it is the best opportunity to buy. Quote number 6. Investment is most intelligent when it is most businesslike. Investing is not speculating or gambling. If you want to gamble, go to the casino or the racetrack. Investing is a business-like pursuit of investing in quality companies at cheap prices. As an investor, you own part of a company that you invest in. Act like it. Quote number 7. The defensive or passive investor will place chief emphasis on the avoidance of serious mistakes or losses. His second aim will be freedom from effort, annoyance, and the need for making frequent decisions. Investing legend Charlie Munger has outlined that good investing is the avoidance of your own stupidity. Quote number 8. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. In the long term, the stock price will always follow the underlying performance of the company. Use volatility to your advantage. Quote number 9. The intelligent investor is a realist who sells to optimists and buys from pessimists. Remember, when prices are in the sky, it's time to say goodbye. But when prices fall, it's time to give your broker a call. The 19th century British banker and nobleman, Baron Nathan Rothschild, is widely credited with coining the go-to catchphrase of generations of investors. Buy when there is blood in the streets. Quote number 10. The intelligent investor gets interested in big growth stocks not when they are at their most popular, but when something goes wrong. How much you pay determines the amount of value you get. Pay too much and you'll get little value. The less you pay, the more value you get. The secret to the game is to always pay less and get more. Quote number 11. Thousands of people have tried and the evidence is clear. The more you trade, the less you keep. The name of the game on Wall Street is to bleed you for commissions. Wall Street makes its money off activity, any activity, and as long as you're willing to go for it, they are happy to take your money. Quote number 12. If fees consume more than 1% of your assets annually, you should probably shop for another advisor. Fees can make a big impact on your investment over the long term. Make sure you're not paying too much. Quote number 13. Never buy a stock because it's gone up, or sell one because it's gone down. Only buy or sell a stock when your investment case has changed, or you've found a better opportunity. Quote number 14. An investor calculates what a stock is worth based on the value of its businesses. The cheaper you can buy a stock, the higher your margin of safety. Try to buy stocks which are trading at a discount compared to their intrinsic value. Quote number 15. A great company is not a great investment if you pay too much for the stock. Comparing the current valuation of a company to its average valuation of the past 5 years is a good start. Remember, the price you pay will equal the overall performance of your return. Don't be in a hurry to pay too much. Quote number 16. People who invest make money for themselves. People who speculate make money for their brokers. And that, in turn, is why Wall Street perennially downplays the durable virtues of investing and hypes the gaudy appeal of speculation. Wall Street is the personification of Mr. Market. Don't get drawn into hype, bubbles, or the next big thing. Quote number 17. Price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. Remember the principle: buy cheap and sell dear. Quote number 18. The intelligent investor should recognise that market panics can create great prices for good companies and good prices for great companies. In a market correction and bear markets, Wall Street will overlook the intrinsic value of a company. If the fundamentals of the company have not changed, then you have an opportunity to take advantage of this mispricing. Quote number 19. A defensive investor can always prosper by looking patiently and calmly through the wreckage of a bear market. Going against the tide or driving against the wind can be harrowing. As humans, we've been told that there is protection in going with the crowd. In investing, you need to be brave when opportunities arise. This means keeping a cool head and looking for bargains. Quote number 20. Successful investing is about managing risk, not avoiding it. Every investor will have stocks that they thought would perform better than they have. That is why you need to ensure you have an adequate margin of safety when you buy a stock. There you have it. The top 20 quotes explained from Benjamin Graham's book, The Intelligent Investor.